Ever felt like you're just drowning in market news? All that data, day in, day out. Wishing there was maybe a shortcut, or at least a better way to grasp the apparent chaos. Today, we're doing a deep dive into one of the most, let's say, intriguing and debated tools out there, the Elliott Wave Theory. Our mission for you, our listener, is really to unpack this thing. It's complex, no doubt. We'll go from its origins, which are fascinating, honestly, back in a really tumultuous time. We'll look at the math behind it, how people actually use it, and yeah, the controversies too, the critiques. The idea is you walk away with the important stuff, the core ideas, and see how it fits into maybe understanding markets better without feeling totally overwhelmed by it all.
That's right. And this isn't just about drawing lines on a chart, not at all. It's really a journey into, well, human psychology, bit of history, even some interesting math. We'll explore why it even emerged when it did, who helped make it popular, and critically, what it claims to tell us about how markets move in cycles.
Okay, let's get into it then. Our journey starts with Ralph Nelson Elliott. He was an accountant, a business consultant, retired at 66, and then, get this, dedicated years to analyzing 75 years of Dow Jones data, specifically between 1930 and 1933. So right in the Great Depression, what drove him to do that during that time, and what did he find?
Yeah, it's a great question. Why then? Why so deep? Elliott was really searching for some kind of order in what looked like total market chaos,
Yeah.
utter randomness. And he discovered, or at least believed he discovered, that markets don't move randomly. They actually move in these identifiable repeating patterns, cycles. And what's fascinating is his focus on crowd psychology driving it all. So it wasn't just technical. It was tied deeply to the social and economic mood of the 1930s. It gives the theory this sort of philosophical soul, like it's quantifying these mass mood swings.
So he found a nature's law in the market. That's a
Yeah.
bold claim. And it didn't just pop out of nowhere, right?
Yeah.
You mentioned Dow theory earlier. How did Elliott Wave build on Charles Dow's work? Did it replace it or?
Right, good connection. It definitely built on it. Dow theory gave us the big picture, the macro framework. Markets move in trends, primary, secondary, minor. And a primary trend has phases: accumulation, public participation, distribution. So if Dow theory answered what? The markets move in trends and phases, Elliott Wave tried to answer how. It offered this detailed fractal structure within those trends. Think of it like a fractal microscope looking inside Dow's trends. Dow's primary trend, that roughly matches Elliott's big 5-wave impulse sequence. Dow's secondary trend, that aligns pretty well with Elliott's 3-wave ABC correction. So it's more specific, more detailed, maybe more rigid too.
Okay, so Elliott publishes his findings. Financial World, his book Nature's Law, how did it catch on globally? I hear names like Hamilton Bolton thrown around, and especially A.J. Frost and Robert Prechter.
Yeah, after Elliott passed away in '48, Bolton kept the work going.
Huh.
But it really exploded in popularity in the 1970s. And that was largely thanks to Frost and Prechter's book, Elliott Wave Principle, Key to Market Behavior. Came out in '78. Prechter especially became the face of Elliott Wave for decades, the most influential interpreter. And what's interesting there is, because the theory is so subjective, inherently subjective, it needed these really persuasive, credible people to build a community around it, which suggests, the whole Elliott Wave world can sometimes feel like a bit of a subculture. It has its own language, its own leaders. Now, that can build strong conviction, sure, but it also risks creating an echo chamber, maybe making it hard to hear outside criticism objectively.
A subculture around a financial theory. That is interesting. Does that make it tough for outsiders to really get it, or just harder to trust? You mentioned that core philosophy, crowd psychology. How central is that, and how does it stack up against, say, modern academic thinking?
It definitely can raise a barrier, yeah. But the core idea is fundamental to the theory. It's this bold claim. Market moves aren't random. They're driven by human psychology. And that psychology moves in predictable, repeating cycles. So the waves on the chart, they're just visualizing those natural swings in collective mood. Pessimism to optimism, back again. Elliott actually thought this was bigger than finance. Part of nature's law applying to lots of human stuff. Looking back now, you could say Elliott was doing behavioral finance decades before it got fancy academic names and Nobel Prizes. His basic idea, collective psychology, creates irrational but predictable patterns that's central to modern behavioral finance. So it kind of reframes Elliott Waves. It's not just some weird charting thing. It's maybe an early qualitative attempt to model how our biases, hurting, greed, fear, mess with market efficiency. Gives it a bit more intellectual weight than critics sometimes admit, even if the specific rules are, well, debatable.
Okay, so markets aren't random, psychology drives patterns. But how did Elliott quantify this? This is where it gets really interesting for a lot of people. The Fibonacci connection. How does that famous number sequence get woven into Elliott waves?
Right, this was one of Elliott's really significant observations or claims. He found the structure of market patterns seemed to follow mathematical relationships from the Fibonacci sequence. 0, 1, 1 to 2, 3, 5, 8, 13, and so on. And this shows up in a couple of ways. First, the wave count structure. A basic cycle has 8 waves, 5 impulse, 3 corrective. 5 and 3 are consecutive Fibonacci numbers. 8 is a Fibonacci number 2. And this scaling continues. Break down a bigger cycle, and the wave counts often end up being Fibonacci numbers like 89 waves total, made of 55 impulse and 34 corrective, all Fibonacci. Second, the ratios between waves. This is where it gets used a lot in practice. Fibonacci ratios, especially the golden ratio, about 1.618, and its inverse, about 0.618. They're used as measuring tools to forecast potential price targets or how far a correction might go. Like, it's common to see wave 2 pull back about 61.8% of wave 1, or wave 3 might extend 1.618 times the length of wave 1. Modern tools use levels like 23.6%, 38.2%, 50%, 61.8%, and so on, all derived from Fibonacci.
But I've heard that's also a huge point of criticism, right? The
Yeah.
Fibonacci link. How does relying on it make the theory seem, well, maybe unfalsifiable or prone to just seeing what you want to see, confirmation bias?
That's a really important critique, absolutely, because you have this list of accepted ratios, right?
Mm-hmm.
And some flexibility in picking exactly where you start and stop measuring. An analyst looking backwards can almost always find some Fibonacci relationship that seems to fit a past price move. So yeah, that can definitely lead to confirmation bias. Seeing patterns that aren't statistically significant. There was a big academic study, Batchelor and Ramiar in 2005. They looked at the Dow Jones data and basically said the frequency of these Fibonacci ratios wasn't really different from what you'd expect by random chance. That's a pretty direct hit on the whole mathematical foundation idea. So the professional way to use Fibonacci, I think, is to see these ratios as potential zones, areas of confluence, probability areas, not as precise, guaranteed turning points. They're hints, not gospel.
Okay, potential zones, not guarantees. Got it.
Yeah.
So we have psychology, we have Fibonacci, but maybe the most mind-bending part of Elliott Wave is this fractal idea, waves within waves.
Yeah.
What does that actually mean? How does this pattern repeat on like a 5-minute chart and a 50-year chart?
Yeah, the fractal nature, it's really foundational and conceptually quite powerful. It just means that the basic 5-3 pattern 5 waves up, 3 waves down in an uptrend, repeats itself at every scale, every level of magnification. From tiny little wiggles on a 1-minute chart up to huge cycles spanning decades, even centuries. Waves within waves. So each impulse wave, like wave 1, 3, or 5, is itself made up of 5 smaller waves. And each corrective wave, wave 2 or 4, is made up of 3 smaller waves. To keep track of all this, Elliott named 9 different degrees of waves, from grand supercycle down to sub-minuet. It gives analysts a way to label patterns across all these timeframes.
Wow. So a tiny little flicker on my screen right now could actually be like wave 3 of wave C of wave 4 of a much, much bigger cycle.
Exactly that. Conceptually, it's elegant, right? A unified framework for all time frames. A long-term investor looking at cycle waves and a day trader looking at minuet waves are, in theory, using the same underlying structure. But practically speaking, big challenge. You have to correctly identify not just the current waves, but where it sits in the bigger picture. Its higher degree. Get the higher degree wrong, and your forecast for the smaller waves is completely off. It's a cascading error problem. And that's a major reason why actually counting waves in real time is so incredibly difficult and, frankly, error-prone.
Yeah, I can see how one mistake up top could mess everything up below. A cascading error, that makes sense. So, okay, it's complex, but let's dig into that core pattern, the 5-3 model. How does that basic 8-wave cycle work? And you mentioned personalities for each wave. What's the psychological story? Because it sounds like it's more than just counting 1, 2, 3, 4, 5. It's reading the crowd.
Exactly. It's about reading the story the market is telling through the crowd's actions. So the basic 8-wave cycle has 2 main phases. First, the motive phase, that's waves 1 through 5. They move with the main trend. So in the bull market, 1, 3, and 5 go up. 2 and 4 are corrections pulling back down. Second, the corrective phase, that's waves A, B, and C. They move against the main trend. In that bull market, A and C go down, B is a bounce back up. And understanding the personality of each wave, that's key. It's not just technical. Each wave reflects a different stage in the collective mood. Hope, doubt, greed, euphoria, fear. It's all in there.
Okay, lay it on us. What are these market personalities? Sounds like a drama unfolding chart by chart.
It kind of is. Okay, let's walk through in a bull market scenario. Wave 1 hope. This is the first little push up from a bottom. Sentiment is still mostly negative from the previous downtrend. It's often hard to spot. Looks like just a bounce. Some smart money starts buying, seeing value. Volume might tick up, but nothing crazy. Wave 2 out. The first pullback, it shakes out some of the wave 1 gains. Skepticism is high. Lots of people think, see, the downtrend's back. They sell. But crucially, wave 2 usually doesn't go below where wave 1 started. Volume is often lower, suggesting selling isn't that strong. Wave 3, confirmation, greed, boom. This is often the big one. Strongest, longest wave. When price breaks above the wave 1 peak, it signals, okay, this uptrend is real. Good news starts coming out. The public hikes in. Greed kicks in. Volume is usually very high. Wave 4, profit taking and consolidation. After that big run up in wave 3, people start taking profits. Causes a correction. Wave 4 is often messier, more sideways than wave 2. But sentiment is still pretty bullish. People see it as a buying opportunity before the last hurrah. Wave 5, euphoria and complacency. The final push higher in the main trend.
Optimism is everywhere. News is great. This is often when the least experienced traders jump in FOMO, fear of missing out. But notice, volume is often lower than in wave 3, and you often see bearish divergence on indicators like RSI, hinting the trend's running out of steam. Wave A, denial. Now the correction starts. This first drop down often surprises people. Many think, just a dip, the uptrend's still fine. Denial. Wave B, bull trap. A tricky little rally back up. It fools people into thinking the uptrend is resuming. They buy. But wave B usually fails to make a new high above wave 5's peak, and volume is weak. It's a trap. Wave C, fear and panic. This is often the most damaging wave down in the correction. As price breaks below the wave A low, fear takes over. Panic selling can happen. This often marks the end of the whole 8-wave cycle, leading to capitulation.
Wow, that's quite the narrative. A whole emotional roller coaster mapped out. So what stops this from just being, a story we tell ourselves after the fact? I hear there are 3 cardinal rules that, if broken, mean your wave count is just plain wrong, instantly. This sounds like where it gets objective, and maybe useful for managing risk.
You nailed it. These 3 rules are the theory's anchor to objectivity, or at least falsifiability. Labeling the waves is subjective, yes, but these rules give you an objective way to invalidate a specific count. For a 5-wave move to be a valid impulse wave, it must obey these. Rule 1. Wave 2 never retraces more than 100% of wave 1, meaning wave 2 can't end lower than where wave 1 began. Makes sense, right? Need that higher low for an uptrend. Rule 2. Wave 3 is never the shortest of the 3 impulse waves 1, 3, and 5 measured by price distance. It's often the longest, but it cannot be the shortest. This highlights wave 3's power. Rule 3. Wave 4 never enters the price territory of wave 1, meaning the low of wave 4 can't overlap with the peak of wave 1, keeps the stages distinct. There is one exception to Rule 3, though, in a specific pattern called a diagonal triangle, but generally that rule holds.
Okay, so if I think I see a wave 2 forming, but the price then drops below the start of wave 1, my count is immediately wrong. Kaput. No wiggle room.
Precisely. Instantly invalidated. And that's powerful. It changes the game from descriptive storytelling to a testable hypothesis. Trade by trade. A disciplined trader uses these rules not to predict, but to manage risk. They can say, okay, I think this is wave 2, so I'll put my stop loss just below the start of wave 1, because if price hits that stop, my hypothesis is proven wrong by the theory's own rules. That's a really critical, often missed, practical application.
I see. It defines your I'm wrong point objectively. That's huge for risk management. So beyond those 3 absolute rules, are there other, let's say, guidelines, things that tend to happen and help confirm a count even if they aren't deal breakers?
Yes, exactly. Besides the hard rules, there are several guidelines, common tendencies that boost confidence in a count. They aren't mandatory, but they help. Like the guideline of alternation. Wave 2 and wave 4 often look different. If wave 2 is a sharp, simple pullback, like a zigzag pattern, then wave 4 is often a more complex, sideways mess, like a flat or a triangle, and vice versa. They alternate in form. Then there's the guideline of equality. Sometimes if wave 3 is super long, an extension, then wave 1 and wave 5 tend to be roughly equal in price length. Handy for estimating where wave 5 might end. Channeling. Impulse waves often stay within parallel trend channels. Drawing these can help project targets for waves 3 and 5 and corrective wave targets. After a 5-wave move up is done, the following ABC correction often finds support around the area of the previous wave 4, especially near wave 4's low.
Okay, rules and guidelines. But markets rarely follow neat scripts, do they? What happens when the basic 5-3 just doesn't fit? I bet there are variations for when things get messy.
Oh, absolutely. Markets get very messy. Elliott cataloged a whole zoo of variations to handle the complexity. First, motor wave variations on the 5-wave impulse. You could have an extension. One of the impulse waves, 1, 3, or 5, stretches out, becomes much longer, and has its own clear 5-wave structure inside it. Wave 3 extensions are common. There's the diagonal triangle, a 5-wave pattern, but it forms a wedge shape, converging trend lines. This is where Rule 3, wave 4 not overlapping wave 1, can be broken. Diagonals often signal the end of a move, and a rare one, truncation or a failed fifth. Wave 5 just doesn't have the oomph to get past wave 3's peak. Signals serious weakness and often a sharp reversal. Then, corrective wave variations on the ABC. Elliott apparently identified like 21 patterns, but they boil down to variations of three main types. The zigzag, 535 structure, sharp, fast correction against the main trend. The flat, 3335 structure, more sideways corrective. Price doesn't make much progress down in an uptrend correction. Can have variations like expanded or running flats. The triangle, 33333 structure, a sideways coiling pattern. 5 waves, A, B, C, D, E, usually converging. Often happens in wave 4 or wave B, suggesting the main trend will continue after it breaks out. And finally, complex combinations. When corrections drag on, the market can glue together 2, double 3, or even 3, triple 3, simple corrective patterns like a zigzag plus a flat, with connecting X waves in between, labeled WXY or WXYXZ, gets really messy.
Wow, okay. Extensions, diagonals, zigzags, flats, triangles, double threes, triple threes. That's a lot. It sounds like the theory really does have an explanation for almost anything the market does. But doesn't that become a problem itself? If there's always a pattern you can fit afterwards, how useful is it for predicting?
That's the paradox, isn't it? It's the theory's descriptive strength. It aims to classify everything, no price action left behind. But it's also its greatest practical weakness. Huge weakness. Imagine you're watching the chart in real time. Which of these dozens of patterns is forming right now? It creates enormous ambiguity, massive subjectivity. Like one critic said, it can feel designed to never be wrong because you can always find some pattern, often a complex corrective one, to explain what just happened after the fact. Makes real-time forecasting incredibly tough, often leading analysts to constantly relabel their wave counts.
Right, constantly shifting the labels, I can see that. So how do the pros actually do it then? How do they apply this in a disciplined way? What data do they use? Is it just price charts?
Good question. You definitely need time series price data. Candlesticks, bar charts, line charts, standard stuff. And it can be applied to pretty much any liquid market driven by crowd psychology, stocks, indices, Forex, commodities, even crypto these days. But successful Elliott wave analysis isn't just about counting waves on the price chart. That's only one dimension. Pros look at it as a three-dimensional puzzle: price, time, and volume. Price gives you the patterns, the waves themselves. Time, meaning looking across different time frames, gives you the context, the fractal degree of the wave you're looking at. Volume gives you confirmation, the energy, the conviction behind a move. Does the volume fit the personality of the wave you think you're seeing? If you only look at price, you're missing 2/3 of the picture. That holistic view is what separates pros from amateurs just pattern spotting.
Price, time, and volume. Okay, a 3D approach. Makes sense. Now, the actual counting process. Is there a logical way to go about it? To try and minimize that subjectivity we keep talking about, like a step by step?
There should be, yes. It shouldn't be random guesswork. A logical process helps a lot with consistency. Here's a kind of flow chart. Step 1, macro trend ID. Start big, weekly, monthly charts. Look for a clear 5-wave or 3-wave move that already finished in the past. Where are we in the big picture? Just finished a huge 5 waves up? Then maybe we're starting a big ABC correction now. Context first. Step 2, zoom in and propose. Drop down to your trading time frame, daily, 4-hour, whatever. Based on that macro context, make a primary hypothesis. Okay, if the big wave just ended, maybe we're now in wave A down. Step 3, apply rules and guidelines. Test that hypothesis ruthlessly against the 3 cardinal rules. Does it break any? If yes, throw it out immediately. Invalidate it. Then check the guidelines, alternation. Channeling, does it look probable? Does it make sense? Step 4, use confluence tools. This is crucial. Never rely only on the wave count. Look for confirmation. Do Fibonacci levels line up? Are momentum indicators like RSI or MACD showing divergence, like bearish divergence between wave 3 and 5 peaks? Does the volume profile match the expected wave personality? Look for multiple signals pointing the same way.
Step 5, identify invalidation levels, the absolute key for trading. Based on the rules, pinpoint the exact price level where your scenario is proven wrong. If you're trading a potential wave 3 up, the invalidation is the start of wave 1. That level becomes your stop loss, non-negotiable. Step 6, iterate and adapt. Markets change. Your favorite scenario might get invalidated by price action. Be ready, willing, and able to ditch it and go back to step 2. Formulate a new hypothesis that fits the new data. Flexibility is paramount. Don't fall in love with your count.
That's step 5, the invalidation level. It really does seem like the most practical, powerful part. How does that shift the mindset away from trying to be a fortune teller towards just managing risk?
It's a fundamental shift. Most traders ask, where's the price going? Right? Trying to predict. Elliott Wave, used properly, forces a better question. At what price is my current idea wrong? Those invalidation points coming straight from the cardinal rules give you objective, hard lines in the sand for risk control. Buying because you think wave 3 is starting. Stop goes just below wave 1's start. Roll 1. Simple. Selling because you think wave 5 ended and wave A is starting. If price goes back above wave 5's peak, your scenario is probably bust. It flips the focus from the impossible game of perfect prediction to the professional game of managing probabilities and cutting losses decisively when you are wrong. Honestly, that might be the most valuable contribution of the theory, even if people often overlook it.
Managing probabilities, not predicting certainties. Okay. But with all this complexity, subjectivity, what do the quants, the academics say? What are the big criticisms from their side?
Well, a major one from the quantitative world is that Elliott Wave is incredibly hard, maybe impossible, to backtest scientifically and objectively. Software can test moving averages or RSI strategies easily, but programming a computer to reliably identify Elliott waves, nightmare. It's because of that moving goalpost problem we touched on. The complexity and subjectivity mean you can almost always adjust or relabel a count after the fact to make it fit the historical data. What looked like a 5-wave impulse fails. Actually, that was just part of a complex WSY correction, see? The rules aren't tight enough to stop that ambiguity, so you can't build a rigid algorithm to test it properly. And if you can't systematically test its profitability over lots of data, well, that's a huge red flag for any quant analyst.
Right. The moving goalposts makes testing impossible. And the subjectivity itself, that seems like the real Achilles heel, doesn't it? You can always make it fit.
It absolutely is. It's the most common, most powerful criticism. Probably fatal in the eyes of many critics. Wave counting just isn't an exact science. It's more like an art of interpretation. You can have two highly experienced Elliott analysts look at the exact same chart and come up with totally different wave counts. And sometimes both counts might seem valid according to the rules. That level of ambiguity just leads academics and quants to say, look, this isn't rigorous. It relies too much on personal judgment. Some critics are really harsh. Call it astrology for finance, basically saying it's belief, not analysis.
Astrology for finance. Ouch. Is there any defense against that? Can the subculture you mentioned bring any consistency? Or is it always just one person's opinion?
That brings up an interesting distinction. Subjectivity versus intersubjectivity. Okay, the theory itself is subjective, but within that dedicated community of practitioners, you can get a degree of intersubjective agreement. People trained by the same sources, using the same materials like practors, discussing charts constantly, they develop a shared way of seeing patterns, a common language for labeling. Now, that doesn't make it objective in a scientific sense, but it can make it consistent within that group. The challenge for someone new is learning that shared interpretation. It means mastering Elliott Wave is maybe less like learning math rules and more like learning a language or even an art form. It takes years of practice, immersion. That's a high barrier to entry and a fair reason why many people just steer clear.
Learning a language or an art form, that definitely sounds demanding. So, okay, lots of criticism. What about actual academic studies? Is there any hard data suggesting it works consistently? Or is it all just theory and anecdotes?
The academic evidence is messy. It's fragmented, often contradictory. No clear knockout punch either way. You can find some studies showing positive results, like one in 2017 said EWT could forecast the euro-dollar exchange rate pretty accurately. Another suggested combining it with AI, like neural networks, got really high forecast accuracy on stocks. Some researchers even tried using its principles to model the spread of COVID-19, arguing that's also driven by crowd psychology cycles.
Really? COVID-19, that's unexpected, suggests the core idea of cyclical psychology might have legs, even if the market application is debated.
Perhaps. But then you have the critical studies that attack the foundations. That Batchelor and Ramyar study from 2005 finding Fibonacci ratios weren't statistically significant in the Dow. That's a big blow, and famous skeptics like Benoit Mandelbrot, the father of fractal geometry, ironically, he was pretty dismissive of EWT's forecasting ability. So, the bottom line for a professional analyst, from an academic standpoint, there's no slam-dunk definitive proof that Elliott Wave is a consistently profitable forecasting tool. The burden of proof is still very much on its proponents. Relying only on EWT for real money decisions, that would be pretty irresponsible academically and professionally.
Okay, so no academic consensus, burden of proof on proponents. Understood. So where does Elliott Wave fit in the bigger toolbox of technical analysis? How does it stack up against other big names like Dow theory, which it built on, or maybe the Wyckoff method? Are they rivals?
Complementary? Great question. Context is key. Let's compare. Elliott versus Dow. We already touched on this. EWT is like Dow theory's more complex descendant. Both see trends, waves, psychology as key. But the differences matter. Detail. Dow is macro 3 trends, 3 phases. Elliott is micro, fractal the detailed 5-3 structure inside those trends. Dow is the map outline. Elliott tries to draw every street. Timing. Dow is mostly a confirmation tool. It tells you a trend changed after it happened, often lags. Elliott, with its rules and Fibonacci, tries to forecast price targets and turning points ahead of time. More predictive, therefore riskier. Complexity. Dow is pretty simple. Elliott is way more complex. Big learning curve. Elliott versus Wyckoff. Now, Wyckoff's is different. It focuses on figuring out what the big players, the composite man, are doing by analyzing price and volume very closely. Compared to Elliott, Wyckoff feels more complementary than competing. Both look at markets in waves or phases. Wyckoff's accumulation and distribution phases line up pretty well with parts of the Elliott cycle. Both try to read psychology and smart money. Many traders actually try to combine them, but their focus is different. EWT is mainly about the geometry of price patterns, 5-3 shapes, triangles, zigzags. Wyckoff is about the dynamics of supply and demand, read through price and volume interaction, cause and effect, effort versus result. And the role of volume is a big difference. In EWT, volume is helpful confirmation, but secondary. In Wyckoff, volume is absolutely core. You can't do Wyckoff analysis without volume.
So they're not really fighting for the same space, more like different lenses to view the same thing. Like Elliott gives you the structure, Wyckoff gives you the supply-demand dynamics happening within that structure.
Exactly. That's a great way to put it. Elliott offers a potential roadmap based on these idealized patterns. Wyckoff analyzes the supply and demand forces driving the car along that road. A really powerful approach could be identify a potential Elliott wave setup. Say you think a corrective wave 2 just finished. Then zoom in and use Wyckoff's detailed price and volume analysis within that wave 2 area. Look for signs of accumulation, smart money buying. If Wyckoff confirms accumulation, then you might take the trade targeting wave 3. Getting confirmation from two different but related frameworks like that can seriously boost your confidence and probability of success.
Combining them for higher probability makes a lot of sense. Okay, what a deep dive this has been. Seriously, we've gone from R.N. Elliott in the 30s through Fibonacci, fractals, wave personalities, the crucial rules, the critiques, the comparisons. Let's try to wrap this up. For someone listening, what are the key advantages and disadvantages of even trying to use Elliott Wave Theory?
All right, summing it up. Advantages. First, it gives you a comprehensive framework, helps put short-term noise into a bigger cyclical context. It clearly defines trend, 5 waves, versus correction, 3 waves, helping you trade with the main flow. Combined with Fibonacci, it offers potential price targets and reversal zones for planning trades, and crucially, the risk management aspect. Those clear invalidation points from the rules give objective stop-loss levels. That's a huge plus for capital protection. Disadvantages. The big one. High subjectivity. Interpretation varies wildly. Lack of objectivity and consistency. Complexity. It's really hard to learn and master. Huge catalog of patterns, rules, guidelines, easy to get analysis paralysis. Lack of academic proof. As we discussed, evidence is shaky, contentious, no solid validation. And finally, it's not always right. Markets don't always follow the script. Over-relying on one count can definitely lead to losses.
Okay, so when does it tend to work best? And when is it more likely to, well, fall apart or just mislead you? Are there certain conditions?
Good question. It seems to work best in trending markets that are clear, liquid, and driven by broad participation. Think major stock indices like the S&P 500, major currency pairs like EUR/USD, markets with strong crowd psychology. It's most effective when used as a tool for context and risk management, like we talked about, not as a crystal ball for exact predictions. And it works much, much better when combined with other tools. Confluence is key. Like a wave 5 target hits a major resistance level, and you see bearish RSI divergence. That's a much higher probability signal. Where does it fail? Prolonged, choppy, sideways markets, no clear trend, no clear waves. Also, low liquidity assets that can be easily pushed around by a few big players, not pure crowd psychology. Using it mechanically, like trying to automate it without human judgment, that usually fails because of the subjectivity. And a big trap, trying to force the market into your preferred count instead of listening objectively to what the price action is actually telling you.
Don't force the count. Listen to the market. Got it. So what's your final takeaway? Your ultimate recommendation for someone listening, maybe a professional analyst, maybe just someone curious who's thinking about using this, how should they approach it?
Okay, my final thought may be an analogy. Think of Elliott Wave Theory as a map, not a GPS. A GPS gives precise turn-by-turn directions. Turn left here. A map shows the overall terrain, possible routes, landmarks where you are roughly. Elliott Wave is the market map. It helps you see the big picture, visualize a few likely paths the market might take. It does not tell you with certainty which path it will take. So for professionals, the recommendations are: use it for context, not signals. Answer: where are we in the big cycle? Not buy or sell right now. Prioritize risk management. Focus relentlessly on those invalidation points. Know when you're wrong and get out. That's more important than trying to be perfectly right. Think in probabilities. Always have multiple scenarios in mind, primary, alternate counts. Weigh their likelihoods. Don't bet the farm on just one interpretation. Demand confluence. Never ever trade just on a wave count. Require confirmation from other tools, momentum, patterns, wiggle-on volume analysis. Embrace imperfection and flexibility. Be ready to recount constantly. Adapting when your scenario breaks is way more valuable than stubbornly sticking to a wrong forecast.
So yeah, it's not easy. Not a shortcut. It's complex, demands patience, discipline, flexibility. But used correctly as a thinking tool, a scenario builder, a risk manager, not a crystal ball, it can be a valuable part of a serious analyst toolkit.
A map, not a GPS. That's a great way to frame it. What an incredible deep dive this has been. We covered so much ground. Elliott's origins, the math, the psychology, the fractals, those crucial rules, the harsh critiques, how it fits with other methods. Hopefully you, our listener, now have a much clearer, more nuanced understanding of Elliott Wave Theory. Not just the patterns, but the thinking behind it, its strengths, its weaknesses, and maybe most importantly, how it forces a focus on risk. You're definitely far more informed now.
Absolutely. And I think this deep dive shows that while it's incredibly complex and subjective, if you approach it with discipline, use it for context, demand confluence, and focus on risk, it can be a useful tool. It helps you ask better questions about the market rather than just chasing predictions.
So let's end with a final thought for you to chew on. A bit provocative, maybe. If markets really are expressions of collective human psychology, and if that psychology really is cyclical, as Elliott believed, what other areas of life's social trends, history, maybe even personal endeavors might show similar wave patterns if we looked closely enough? And what might that tell us about the deeper rhythms in our own collective and maybe even individual behavior? Something to think about. Thank you so much for joining us on this deep dive. Until next time, keep digging for those insights.